1971 marked a turning point in the history of the international monetary system. In August of that year, President Richard Nixon announced that the United States would suspend the dollar's convertibility into gold. This effectively brought the Bretton Woods monetary system to an end. The decision permanently reshaped the international monetary system. Over the decades that followed, it became part of a new financial era marked by persistent inflation, rising debt, and financial bubbles. Soaring asset prices and growing inequality defined this period. For many people, that's where the story begins. It shouldn't. The conditions that led to Nixon's announcement had been building for years. By 1971, the Bretton Woods system was already under severe strain. The United States had issued far more dollars than it could redeem. As those dollars accumulated overseas, foreign governments increasingly exercised their right to exchange them for gold, steadily reducing America's reserves. The system could no longer keep the promise on which it had been built. Richard Nixon's announcement didn't create that reality, it acknowledged it. The real question, then, isn't why Nixon ended gold convertibility. It's why the international monetary system reached the point where such a decision became unavoidable. Before we go back to 1944, if you enjoy documentaries that explain the history behind today's economy, consider subscribing to Financial Cycles. To answer that question, we have to go back to 1944. The Second World War was still raging when representatives gathered. Representatives from 44 nations gathered in Bretton Woods, New Hampshire, to design a new international monetary system. It was intended to rebuild the global economy, restore confidence in international trade, and prevent another Great Depression. To understand why that system eventually came to an end, we first have to understand why the world believed it would work. By 1944, the Second World War was nearing its end, but the economic damage extended far beyond the battlefield. Across Europe and parts of Asia, factories, railways, ports, and entire cities had been destroyed. International trade had collapsed, and the economic turmoil of the interwar years was still fresh in the minds of world leaders. The architects of the post-war order believed that winning the war would not be enough. Without economic stability, they feared the conditions that had contributed to the Great Depression and global conflict could return. In July 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire, to build a new international monetary system. Their goal was to create a stable framework that would support reconstruction and restore confidence in the global economy and peace. The system they designed combined the stability of gold with the practicality of the US dollar. Each participating country agreed to maintain a fixed exchange rate against the dollar, allowing only limited adjustments under exceptional circumstances. In return, the United States guaranteed that foreign governments could exchange dollars for gold at a fixed price of $35 per ounce. This gave countries a reliable monetary anchor. Instead of transporting gold to settle payments, governments could hold dollars, and confident those dollars could be converted into gold whenever necessary. Gold remained the foundation, while the dollar became the currency that made international trade and finance possible on a global scale. The arrangement reflected the realities of the post-war world. By the end of the war, the United States had become the world's largest economy and held roughly 2/3 of the world's gold reserves. No other country possessed the financial strength or the gold reserves needed to support an international system of that scale. To reinforce this framework, 2 new international institutions were established. The International Monetary Fund was created to provide temporary financial assistance to countries facing balance of payments problems. The World Bank was established to finance reconstruction and support long-term economic development. For more than 2 decades, the Bretton Woods system delivered exactly what its architects had hoped for. International trade expanded rapidly, investment increased across borders. Western Europe and Japan experienced remarkable recoveries, while stable exchange rates gave businesses the confidence to plan and grow. But the system's greatest strength gradually became its greatest weakness. As the global economy expanded, trade required more dollars. The only way was for the U.S. to send increasing amounts of its currency overseas. With every additional dollar circulating outside the United States, the promise at the heart of Bretton Woods became more difficult to keep. The system depended on confidence that every dollar held by foreign governments could ultimately be exchanged for gold. Once that confidence began to fade, the stability of the entire system would be called into question. For more than 2 decades, Bretton Woods provided the stability the world needed. International trade expanded, economies recovered, and the US dollar became the foundation of global commerce. But as the global economy grew, so did the pressure on the system. Every expansion in trade required more dollars. Every new investment and international transaction increased the world's demand for US currency. The United States supplied those dollars through trade deficits, foreign investment, and military spending throughout the 1950s and 1960s. The arrangement fueled global economic growth. But it also created a problem that became harder to ignore.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Every dollar held outside the United States represented a promise. Foreign governments and central banks had the right to exchange those dollars for gold at $35 per ounce. As more dollars circulated around the world, America's gold reserves failed to keep pace. The gap between dollars and gold widened. For a time, confidence held the system together. Most countries continued to treat the dollar as good as gold. But confidence depends on trust. And trust began to weaken. Among the first governments to openly challenge the system was France. President Charles de Gaulle argued that the United States enjoyed an extraordinary advantage. Because the dollar served as the reserve currency, America could finance spending by issuing more currency, while others had to earn it through trade. Rather than continue accumulating dollars, France began exercising its right to exchange those dollars for gold. Other countries paid close attention. Governments questioned whether the United States still possessed enough gold to honor every dollar. America's gold reserves continued to decline. The foundation of Bretton Woods was beginning to crack. By the summer of 1971, the pressure had become impossible to ignore. Nixon announced the suspension of the dollar's convertibility into gold. The decision was presented as a temporary measure to protect the American economy. It never became temporary. The gold window never reopened. Contrary to popular belief, Bretton Woods did not collapse because Nixon made that announcement. It marked the moment the U.S. acknowledged it could no longer maintain the commitment at the center of the system. For the first time since the Second World War, the international monetary system was no longer anchored directly to gold. A new financial era had begun. When Bretton Woods came to an end, the global economy didn't collapse overnight. Trade continued. Banks remained open. Businesses kept investing. For most people, everyday life changed very little. The real transformation wasn't immediate. It was structural. That gave governments and central banks far greater flexibility in managing their economies. With the link to gold removed, the US dollar had effectively become a fiat currency. The word fiat comes from Latin, meaning let it be done, or it shall be done. In other words, money no longer derived its value from its convertibility into gold, but from the authority of the government that issued it. The stability of the monetary system no longer depended on gold reserves. It depended on confidence in governments and central banks. That change reshaped the foundations of modern finance. It created a different monetary system. What happened afterward depended on the decisions made within that system. The first major test came just 2 years later. In 1973, the oil crisis sent energy prices soaring, triggering the highest inflation many advanced economies had experienced. At the same time, economic growth slowed dramatically. The combination of high inflation and weak growth became known as stagflation. Governments and central banks struggled to respond. Throughout the 1970s, inflation remained stubbornly high across much of the developed world. The end of Bretton Woods made greater monetary expansion possible, but it did not make inflation inevitable. Energy shocks, fiscal policy, and broader global developments all shaped the decade that followed. 1971 changed the rules. The decades that followed determined where those new rules would lead. The end of Bretton Woods changed the monetary system. It did not determine what came next. What followed depended on the decisions governments, central banks, businesses, and financial markets made over the decades that followed. By the late 1970s, many advanced economies were struggling with high inflation, slow growth, and rising unemployment. The post-war economic model was under increasing pressure, and policymakers began searching for a different path. Another major transformation began during the 1980s. Leaders such as Ronald Reagan and Margaret Thatcher introduced significant economic reforms. While their policies differed, both favored freer markets, reduced government intervention, and broader financial deregulation. At the same time, central banks made controlling inflation their highest priority. Higher interest rates eventually brought inflation under control. Financial markets expanded rapidly. Capital moved across borders with unprecedented speed. Credit became more widely available to households and businesses. Asset prices became a larger driver of wealth, while stocks, bonds, and real estate played an increasingly important role in economic growth. Globalization accelerated these changes. Manufacturing shifted to lower-cost regions. International supply chains expanded and capital flowed more freely. Global trade reached record levels. Innovation accelerated. Hundreds of millions of people were lifted out of poverty. But the new system also introduced new risks. Higher debt left economies more vulnerable to rising interest rates. Increasingly complex financial markets made crises more difficult to predict. Wealth became increasingly concentrated among those who already owned assets. Inequality surged. Over time, debt grew faster than the real economy. None of these developments was a simple result of ending gold convertibility. They emerged from decades of policy choices, financial innovation, and global economic change. By the 21st century, the world had moved far beyond Bretton Woods. The rules changed, the institutions evolved, the global system became larger, faster, and more interconnected than anyone in 1944 could have imagined. More than 50 years later, the decision made in August 1971 continues to shape debates about money, inflation, debt, and the future of the global economy. Some see it as the moment everything went wrong. Others argue it changed very little. History points to a more balanced conclusion. Ending the dollar's convertibility into gold did not create every challenge facing the modern economy, but it did remove one of the most important constraints. From that point forward, the global monetary system no longer depended on a tangible, real value. It depended increasingly on trust. Trust in governments, trust in central banks, trust in financial institutions. Everything that followed, inflation, deregulation, globalization, rising debt, and the expansion of financial markets, was shaped by the decisions made within that new system. That's why 1971 remains one of the defining turning points in modern economic history. Not because it explains everything, but because it changed the rules under which everything else evolved. The monetary system didn't fail because Richard Nixon ended gold convertibility. Richard Nixon ended gold convertibility because the system had already reached its limits. That distinction changes the way we understand modern economic history. Perhaps the most important lesson is this: economic systems rarely change because of a single decision. They evolve over time until the old rules can no longer survive and new ones take their place. Trust can take decades to build. Trust can be lost in a moment. Trust is fragile. 1971 was one of those moments. Not the beginning of today's economy, but the beginning of a new financial era. If you enjoyed this documentary, like the video and subscribe to Financial Cycles for more stories behind today's economy. Thanks for watching.